Welcome, everyone. It's Angelo Robles, the founder at Family Office Association and the host of the Angelo Robles podcast. Today, we're featuring in early October of 2021, to give you context, real estate in 2021 and a look ahead to 2022. Our special guest is Lonnie Gienger of Wilkinson family of companies. They are a national real estate and asset management platform that has transacted on over 2.5 billion of real estate in multiple asset classes over 30 years. Lonnie, welcome back to the show.
Thanks, Angelo. Great to have the opportunity for the conversation.
Well, thank you. When it comes to, let's broadly call it, usually as an illiquid asset, I would say real estate is probably the most common for many that are ultra high net worth investors. Safe to say that COVID has been incredibly impactful, both on the residential and the commercial side. So there's really lots of opportunities to dig deeply into kind of an outlook for the industry and the community, both currently in 2021, and as I mentioned, looking ahead to 2022. Why don't we begin, of course, with something that on the surface is China, not the US, but I think may have very, very broad implications. I'm almost wondering, is this China's version of Lehman Brothers in 2008? And if that is the case, what is going to be their AIG and their Bear Stearns and everything else? So I'm watching this very closely. So that question is, how will the Evergrande crisis impact US real estate?
Yeah, obviously it's front and center in a lot of our minds, especially in recent weeks here. We live in such a globally connected society these days. If something happens on one side of the world, like there will be some impact felt on the other side. And our financial systems rely so much on each other these days. Just about every major nation is really relying on some type of foreign investment strategy and money across the globe. So that's why I think so many in the US are panicking right now about the situation that's occurring thousands of miles away in a country that, you know, traditionally has been considered a bit of a rival to the United States. And yet, from my perspective, we actually have done quite a bit of business in China. We have other investors from China that have co-invested with our US real estate projects. I've made dozens of trips to China. So, you know, have good friends there. And just from a pure friendship to friendship basis, it's really interesting seeing their perspectives on this and also interpreting what I think is likely to happen in China in terms of the impact on the US. So, you know, well-publicized financial challenges the audience is well aware of. But it really has investors questioning whether potential debt default by Evergrande will lead to, like you said, Angelo, a global financial contagion similar to what we experienced in 08-09 with Lehman, or at a minimum just a ripple effect through the global real estate markets. So if Evergrande does collapse under the weight of its massive debts, first of all, it will clearly have a major blow to the Chinese economy. I mean, Evergrande's stock price, I think, already fell over 80%, and
yes,
you know, clearly something's going to happen there, right? So the question is, you know, how will it impact the U.S. And particularly real estate? And you know, thoughts on that are still divided. Of course, the immediate impact of the crisis when it was announced, the pending default, the Dow dropped by like 600 some points. When the news first came out. But really, you know, you've seen U.S. investors, I think, become overall more confident that the ripple effect won't be so significant. And the U.S. real estate market in particular, I don't think will be impacted in a significant way due to Evergrande in particular. What it does do is increase the volatility of the global financial system, which is why investors panic, right? But as the issues become clearer in China, it seems that the impact will largely be a Far East regional issue, despite the global nature of our financial system. I think the Evergrande issues, the challenges will be resolved. Obviously, one way or another, they'll be resolved. And you know, opinion is split for whether it looked like the Chinese government might step in and intervene. Certainly, from my experience over there, they have all the tools at their disposal to do that if they want to, way more than we have in the US, right? So they can step in. But I think that the lenders to Evergrande are more likely to work collaboratively on a restructuring. So, my view is really that the global financial contagion is not in the offing in a way that's going to significantly impact U.S. real estate market in a negative way. I will say, Chinese investors, as I just mentioned, we've had some invest with us. They were a significant part of U.S. real estate investments, really, late 2010s and especially like 2017, 18, there was a ton of Chinese investment. It's certainly possible that Chinese investment activity in global real estate could be restrained even more for the foreseeable future. Of course, the Chinese government has imposed its own constraints, and that doesn't seem likely to let up probably anytime soon. But on the flip side of that, for U.S. real estate benefits, I think there could be an increased flight to safety, we'll call it, not just from Chinese investors, but from other parts of the world that, as you know, many parts of the world have invested heavily in Chinese real estate because it's been on a rocket ship, right? But now that rocket ship is faltering substantial and its future is uncertain. So there's already a lot of capital on the sidelines seeking good real estate investments that I think this flight to safer real estate investments could lead to increased investment activity into U.S. real estate. And if that happens, obviously increased capital investment in the U.S. could lead to further compression in cap rates, which hopefully will potentially offset some of the impact of the inevitable rising interest rates that are coming here. So one other thing I'll mention that I think is on people's mind is just the impact on the supply chain and how that affects U.S. investments in real estate. Yes. I'll talk more specifically about real estate in that, but certainly there's a potential of a decline in exports from China as a result of their economic crisis, but that really involves still a lot of hypotheticals. So on the flip side, there is another possibility that I think might even be more possible, that the reduced construction activity in China, because again, the construction activity in China has just been off the charts for years now. The reduced construction activity in China could result in less upside pressure on raw materials and on building products and probably overall supply chain issues in the US, something that's been pressuring commercial and residential real estate developers in the US and frankly around the globe. So, overall, I'm more on the side that not only will it probably not be catastrophic to U.S., particularly U.S. real estate, but potentially even some upside benefits.
Very interesting perspective. And yeah, that's been one of the most common questions I'm getting on, as I pronounce them, Evergrande. Really interesting insight and something we'll be watching and following closely. For our live participants today, assuming you have my info or send me a reach out, a little bit of a quick shameless plug. Tomorrow at 9 a.m. Eastern, I know that's early for some of you, I'm doing a live interview with Richard Turin, who's the author of best-selling book Cashless. He's of Western heritage, Richard Turin, who's been living in Shanghai for a long time. He's one of the world's experts on fintech, on China, and we're going to have a very deep discussion, including about China, Evergrande, fintech in China, AI, and of course, central bank digital currencies. And it may get a little argumentative. So it'll be a lot of fun. Let's hope he stays with me for the 90 minutes. I'm not sure. We'll find out. For those of you that watch the video on YouTube, we'll see if we made it through. Lonnie, current recovery status and outlook for primary, we'll get to residential later, but for commercial real estate asset classes, maybe define what those core asset classes are and give us some insight as to how it played out this year and maybe some of your opinions looking forward.
Sure. Yeah, it's been really fascinating. Certainly hasn't been boring the last couple of years, tracking all the really daily changes in the dynamics in the real estate, both current conditions and outlooks. It's for a while there last year, it was like everybody's guess of the day. But there's things that are starting to become much more clear now, and some data and trends that we're seeing. So, all four major U.S. commercial real estate types have really started posting strong double-digit annual price growth, like August, September. So the overall U.S. Property value index is like in the teens, 12-13% year-over-year increase. from the data we look at. So I would say, to just run through the four real quickly, multifamily and industrial, those two are the hottest real estate investment classes undoubtedly right now, for a lot of reasons, which we have time, we can go into some of that, but they've shown to have the strongest pricing growth this year. And apartment prices, I think, lead the way with 14-15% year over year gain. I think that's the fastest annual growth rate we've seen since the housing boom that happened before the 08 global financial crisis, right? So it's crazy. Multifamily property prices, rose like, 1.5-ish from just July to August alone. Right, so it's been crazy. So this year, like we closed on a couple of properties, multifamily properties this year, where the market pricing rose significantly in the just 2 or 3 months between when we agreed with the seller on the price and when we closed, right? Wow. Whereas if we walked away from the deal, didn't go through close, they would have gladly pulled it and could have gotten significantly, higher price, right? And that was caused both from, dramatic increase in rents, so revenue increasing just in that 2 or 3 month period, and continued cap rate compression, both dynamics. So that's a snapshot on multifamily. With industrial, I mean, that's the other darling right now in commercial real estate. Again, prices have been up in the teens year over year. And again, we can go into reasons for that. Retail, everybody's been scared of retail for obvious reasons, but at least on a year over year basis now, there's healthy growth in that 12% range, I think. And clearly suffered a lot during the COVID era. And some, with the exception of some segments like grocery anchored centers, they've stayed pretty strong. But the other category is office, right? So everybody's been running away from office, both in employees and investors, right? And yet, at least on a year-over-year basis, we see some strong growth again in the low double digits. But most of that is fueled. It's interesting. It's mostly fueled by the suburban office prices, which right. have increased the most year over year. So the central business district office prices, frankly, in most markets, continue to move in the opposite direction at an annual decline, even year over year. So it's really the suburban office prices that have driven that year over year growth. So, and the other thing I'll just say, broad market comments, is just deal activity in U.S. commercial real estate has risen significantly, like triple digit type growth in August, September on a year-over-year basis from the lows of this time in 2020. So, a lot of health signs, but to really know, what's what and what makes sense, you have to dive deeper in each of those asset classes to understand what makes sense and what the potential pitfalls going forward are.
Yeah, I mean, I think the takeaway, and this has always been the case, so I'm probably not saying anything new here, but maybe now more than ever, real estate is so localized. You could give broad averages, but it may be so completely different from New York to Miami to Austin to your backyard in greater Seattle to LA to San Francisco. So different. I mean, look at offices in Midtown New York. I could argue gravely challenged. In my 10 trips to Miami so far this year, it seems like every time I go there, the pricing for everything, including hotels, including potentially looking at office space, keeps on going up and up. So areas like Miami and Austin, this has been a boom for them, but that also is causing prices to skyrocket. And that's the trade-off that you as an investor have to look at.
Yep. Well, and you've got just the general inflationary pressures that everybody knows about. I mean, the Fed and many of our, current government folks are, I think, grossly underestimating inflation, both the size of price increases and the impact, right? I think we all know that, right? It's so interesting to see that. I've heard the phrase so many times that inflation is transitory, right? But it's a long transit, I think. Sure, some supply bottlenecks will ease, but look, McDonald's is not going to stop paying workers, $15 an hour and more. I just saw a sign at a taco time place here in a local town, $20 an hour, right? Starting wage. It's crazy. So, they're not going to stop that. UPS is not going to charge less to deliver a package as their labor costs have increased. So at least it's highly unlikely. So, and, online prices have increased for the last year and a half, basically. So, the Federal Reserve and Congress continue to pump all this money into the economy. And the longer it takes for the Federal Reserve to realize that inflation is not transitory, the bigger I think our future economic challenges will be. So just watch the CPI in the next 6 months. I think it's going to stay elevated, which will force eventually the Fed to react. Unfortunately, it might be too late to avoid substantial heartburn in the economy. So, with that backdrop, the question is, where do you look for investments? And obviously, as interest rates just started to hint at increasing, what's the impact on everything from that too? So
I completely agree. And I've been saying, and my audience is probably getting tired of me saying this, but especially for those that are, let's call them the rich or the super rich, that want to buy more of things appreciating in value, which usually makes sense, whether it be stocks, whether it be, let's go with cryptocurrencies, with art, with sports teams. Their inflation is very far from 3 to 4%. I'm going to agree with one of our special guests we had on, Michael Saylor. It's probably closer to 20% or up. And to think that, again, maybe investing too conservatively really erodes your purchasing power over time, depending on spending habits and what you want to buy more of. And I think that's gravely underestimated. Related to my two comments and your comment in between, how do you find good investments when prices are so strong, especially in some of the markets I described in Austin or Miami? It just may not make much financial sense. I don't know.
Yeah, I mean, it's fascinating. The real estate investment climate continues to see such aggressive growth across virtually all asset classes now. So some of us who have been around a while, our company's been doing this 30 years, and we question whether current pricing is in line with valuation in many cases, and know that these aggressive rent increases and continued cap rate compression is just not sustainable. So where's the sense in that, and how do you get deals done now where you almost feel like you're overpaying, or at least paying top of market dollars? So the good question you're alluding to is what properties are worth paying top dollar for today, right?
Yeah.
And of course, like everything, the old saying is, what is it? Beauty is in the eyes of the beholder, right? So some people look at a deal and say, whoever pays that much for that asset is nuts. I've said that a number of times, but been proved right sometimes.
10 years later, right? Like,
right,
maybe not.
5 or 10 years later, the investor who bought the property is proven to be a genius, right? But maybe it's luck, or maybe it's the rising tide lifting all boats dynamic, or maybe in some cases that investor really saw something that others didn't. So for me, the reason I love real estate is that's part of the beauty of real estate, is there's real opportunity for investors to use knowledge and expertise to outperform the market and create value. So the current climate's very aggressive, with deals selling at these unheard of cap rates. I mean, apartment deals in Texas with cap rates in the 2s, and industrial transactions in major hubs like LA selling in the same range. It's insane. We're selling, we have a property under agreement to sell right now, an $80 million property. It's over 30 years old, multifamily property in Atlanta that, it's under agreement for in the mid 3 cap range, right? It's just over 30-year-old property. So there are trades happening that are really pressuring the pricing envelope in virtually all real estate sectors. So why is that? I think some investors just aren't experienced in this, and are underwriting. They haven't been through multiple cycles like we and others have been, and they're underwriting based on the exuberance of the current double-digit rent growth that we've been seeing lately. Other more experienced investors are looking at longer term drivers, right? And that can make sense, and they're baking those factors into their underwriting. And I think there's also some of us that are looking for that angle that others simply aren't considering. So what we like to do is we look at both longer term drivers, and we also look for those angles that others might not be considering. It's like we have a property under agreement to purchase right now that was purpose built as a conventional multifamily property, but was converted to student housing. Was owned and operated by a guy that we know who only does student housing. So it was marketed as a student housing property. And we've done student housing, but our real focus is multifamily these days. And so, we're getting a 5 cap on a great property, 52-acre, beautiful campus, strong cash flow, 8 to 10% current yield, mid-teens to high teens IRR and a 5-year hold. But so first of all, there's several long-term dynamics that make that a good play. It's a long-term path of growth, et cetera. And it's a unique play, this needle in a haystack find to create value, converting a property that was purpose built as conventional, currently for many years operated student, converting it back to multifamily, doing some improvements, driving the rents, et cetera. So that's an example. So some investors are willing to essentially overpay for assets that capitalize on long-term trends that aren't already baked into the price. Like in office, you see people buying these suburban office buildings that right now are pretty hot, and they're betting on that the long-term trend will be strong for suburban office, or multifamily markets where there's strong, both office and multifamily markets where there's a strong in-migration of talent and companies. I have a friend of mine who does self-storage facilities almost exclusively, and a play right there is to buy in supply-constrained areas and areas that have also rising millennial populations. So, there's always, it's one of the things I love about real estate is you do need good information. You have to understand the property, you have to understand the market, the sub-market, you have to understand the forces that will impact the property over the next 5 to 10 years. And then if you can align a piece of real estate within the context of who the tenants will be in the future, what the sub-market will look like in 5 years, when you do that, you can, we like to call it being scrappy. You can get a bit scrappy and find those opportunities that take advantage of anomalies and nuances that are affecting the market today. So, of course, in real estate, though, the big payoff comes over the span of years. And so thinking long-term is so important always, but particularly in this environment.
How will remote work and the return to work dynamics impact real estate investments?
Yeah, it's really interesting seeing that play out, because when COVID first hit, a lot of us were thinking, yeah, this will be over in a few months and we'll be back to the office. But remote work, it's becoming clear it's going to impact housing demand for sure for years to come. And I think office trends also, as people who no longer have to be at their workplace 5 days a week prioritize things like affordability and space over a short commute, right? That changes everything. It's a dynamic that changes so many things in what we look for in real estate. So, various aspects of working from home, I think, are now much more important to people. People kind of got to like the greater control of their life and their time and the freedom to live where they want. It's like once you've tasted freedom, it's hard to go back, right? It's, I think, particularly strong among millennial and Gen Z workers. I read an article here recently about a poll, and I don't remember the size of the poll, but a poll where basically they asked workers if they would be, what their view on their job would be if they were encouraged to work from the office more than they wanted to. And 50% told the poll that they're at least somewhat likely to consider getting a new job if they ended up having to work in person more. That trend is not just going to go away, I think. No. So the net of that is, I think, the latest research, I think, shows that return to office is directly correlated with high vaccination rates, low infection rates, et cetera. And so we're starting to see probably first quarter, most predictions are first, second quarter of next year, we'll start to see that happen a lot more, assuming Delta variant impact continues to decline and there's not some new crazy variant that derails the process here again. But it's interesting that even while businesses are expecting to, reopen their office if they're not already open, like our office has been open, but people, some are working from home, some from here, but it appears that the vast majority are still expecting kind of like a 3-2 model, like 3 days a week in the office, 2 days remote. And that's still, that trend is not just going to disappear. So it's going to affect things for quite a while.
We did address it partially earlier, but we'll do a little deeper dive, maybe more specifically from here within the US this time. How will labor and supply chain challenges impact new real estate supply?
I think that labor shortages and wage increases will continue to create headwinds, frankly, for real estate investments this year. I think it will abate again, barring some new crazy anomalies here. But I think it's going to abate a bit in 2022. But there's like a 2.5 million worker shortage, depending on what stats you look at. Right. And you got these rising wages, which will, particularly in real estate, it has this restraining effect on the service components related to commercial real estate, especially asset classes that are highly employee intensive, like hotels and senior housing, right? We have a senior housing property. We had to, raise all of our wages fairly significantly here in recent months. And obviously that's a big impact on outcomes, right? So, I think overall still the future conditions for commercial real estate should be in general favorable. But we'll see how, I think we've recovered 75-80% of the jobs lost during the pandemic now. So that's good progress. Something like 5 million jobs that were created this year alone, which I think it's one of the best job creation years ever. But there's still, a record number of job openings out there, right? So, with the expanded unemployment benefits having ended a month ago, I think labor force participation should accelerate, and it appears to be. But, it's still having an impact both on, the two big areas in real estate are real estate that relies on CapEx. Real estate plays that rely on CapEx because it's hard to get both the goods to do the CapEx as well as the labor. Real estate that has service components that are labor intensive, and those costs for wage increases are a big wild card. And of course, development, construction. It's been really interesting. New construction has been challenging, just if for another reason, because of limited, builders competing for limited talent, which is causing wages to rise, and the pricing of those materials still being high. So I don't know if we want to talk about that at all, but people watched materials prices gone wacky, high in May time frame of this year, and then dropped to less than half here. Right. But again, starting to climb again. It's fascinating. I think futures dropped to up to 1,700, dropped to 600 here mid-September, I think. And I think 500 to 600 range is going to be probably, I would say, the new normal for the next 12 months anyway. But nothing is really normalized yet. And as you have the inflation and labor issues cropping into pricing of everything, it's hard to get labor today and hard to get the products. So, generally disrupted supply chain for raw materials and finished goods and greater demand from builders. Bottom line, there's this increasing demand without much higher supply. So prices are going to continue to rise. I mean, if you're investing in development projects, make sure that there's a really strong contingency built in there and the numbers still make sense.
Should the population migration impact someone's investment strategies in real estate?
Yeah, definitely. It's interesting. There is this, clear migration pattern that we see. Before the pandemic, I would say there was some situations where economic growth was concentrated in these global gateway cities, right? And it was putting a strain on resources and creating crisis level housing affordability challenges. So we had so much economic growth and population congregating these global gateway cities, and the cost of housing was so high. But during the pandemic, that all changed, right? People were no longer tethered to offices, and many opted to move to these smaller cities. So we have this population that's on a move, both within metro areas and across metro areas. So, our experience with that, our view on that is, first of all, multifamily or just residential in general, but particularly multifamily is obviously positioned well to respond to that fundamental movement of people. At the first part of the pandemic, there was a bit of a contraction in demand because a lot of young Americans were still employed and stopped forming households. But it seems that we've now seen this an increase again in new households being created over this year. Mm-hmm. And what happened is fascinating, is that the movement patterns were actually so dramatic and quick, they actually overwhelmed some cities, right? There was excess supply that was in some less metro areas, like especially in the South and Western states. But those got fairly quickly absorbed and then overwhelmed, where we saw rents being driven 20-30% plus from pre-COVID levels in those cities. And I think early in the pandemic, we wondered if those migration trends would really stay, if they would shift economic centers from urban core to the suburbs. And I know some even predicted the death of big cities altogether, right? I mean, but I think that theory quickly fell flat. So this year, the apartment sector, which we look most closely at in most urban markets, has already demonstrated some pretty good recovery. There are some exceptions, like downtown Washington D.C. There's San Francisco, where rents and occupancies haven't yet really recovered. But for multifamily investors, I think the trend is creating a lot of opportunities in new markets, and that's actually pretty exciting.
Lonnie, is there a path forward for the hardest hit asset classes in real estate, office, retail, senior? Yeah,
I think there's always a path forward. It's just how many changes and who makes money on the path, right? So, I'll start with office, because that one seems to almost be, for a while, it was almost a laughing stock if you were investing in office, because it's taken the, office and hospitality, taken some pretty hard licks during the pandemic. But I think that seems to be changing somewhat. The move towards stabilization and fundamentals, I think, is the overarching theme here as we're entering the fourth quarter of this year. So I think we're starting to turn the corner. It looks like even, the office sector, we certainly saw a strong correlation over the last year or so in the COVID-driven downturn, but it's still declining, but the pace of decline has slowed, right? It's like you're still sliding downhill, but you're sliding slower. So the scale of occupancy losses, I think, will continue to lessen. And I don't think, from what I see in office, and again, I'm not as much, we've done some office, but not as much of an expert on office. But it does seem like it'll turn to positive market absorption, I know, sometime in next year, again, barring some anomaly. But part of why I say that is, it's interesting, if you look at the reports on just different trends in different asset classes, I think it's something like a third of all of the 60-some major U.S. markets that a lot of groups track. It's like a third of those major markets are already starting to see positive office absorption in this last quarter. So, the impact on office has certainly been drastic, but it's interesting to see that. I think we'll see some turnaround. Certainly, there's a lot of plays at repurposing office to life sciences,
Yes.
things like that. There's some great plays in the office around that. But if you're a long-term investor, right property in the right market, could be some great buys out there now in office. So what was the other one you mentioned?
Senior.
What's that?
Senior.
Senior. Oh yeah, senior. Know that well. For those of you who don't know our story, we at one point in time had 50 some properties in over 18 states, over 2,000 employees on our payroll just in our senior housing division. So we know that well. We started exiting senior in, we sold a big chunk of our properties in 2007, right before the recession, which is of course more benefit than we realized at the time. Built another 17 senior housing properties post-recession, but then really have been in a selling mode on senior housing for a number of years because of what we see. We saw it happening from the Great Recession. A lot of developers got into that market because it fared so well during that time, and so everybody and their dog was building senior housing in markets they shouldn't have been adding supply to. And we saw that occupancies would likely be softening, which they have in recent years. And of course, COVID, everybody knows the story of there, softened occupancies even more to below 80%. And so definitely it was very strongly hit by COVID. But I will say that senior housing has started to show some signs of recovery. We're down to one senior housing property left, and it's actually under agreement to sell right now. So I will say, demand for senior housing properties did begin to recover just this last quarter a little bit, and vacancies dropped nationally just a little bit. Rent growth has started to pick up just a little bit across all four major care types in senior. But not a ton. So, I think it's too early to say if the stress has really bottomed out, especially given this, the recent resurgence of the Delta and potential other strains. But at least recent data did prompt a bit of optimism for the senior housing sector in the shorter term. But I will say, again, for investors who are long-term investors, again, you look at the long-term trends, the demographic trends are still there, the demand in coming years is still arguably very strong. So it's just a matter of how much supply will come into the market. And so senior, there's still a little early to tell whether it's really turned the corner. There's still a lot of risks. The healthcare risk is very dramatic, and since the economic challenges we've had are healthcare prompted, it's definitely more at risk and more volatile, and that shows in cap rates. Have not gone down like, for instance, like multifamily in that asset class.
For sure. And Lonnie, we do have a question in from one of our live participants, Vanessa. What about the outlook on industrial properties? She states, I'm seeing astronomical prices. I have 54 commercial properties and acquisition is becoming harder. Now that does cue me up. Vanessa, I'm assuming you're correct, but it must be a hell of a time to want to sell. But it looks like you don't want to sell, you want to buy. That could be a good thing. And the ending is, do you see some softening in that?
Yeah, I mean, it's been fascinating to see what's happened here in the industrial sector. And, industrial has gotten a lot of attention. I think there's, everybody knows the drivers for that with all the e-commerce and, so many factors that have driven that. Again, it is a great time to sell, frankly, both industrial and multifamily, because cap rates are so crazy low. The long-term trajectory, I think there's some question about, well, certainly the cap rates can't keep going down, right?
Right.
So interest rates are going to start going up. There's pretty much only one way to go with that. And so what does that do to the values? The counterbalancing pressure I alluded to earlier is, the flight to safety globally in real estate. And so both in the US and from outside the US, you have all this capital chasing, well, frankly, here's how I look at it. A lot of the capital that was chasing all asset classes in the US has especially recently pretty much focused down to just industrial and multifamily, right? So you have so much investor demand. I think that is going to continue because the fundamentals of both of those asset classes still bode well in coming years here. So I think there's a reasonable chance that despite rising interest rates and other dynamics here in the market, that those two asset classes, and I think there will be some upward pressure on cap rates, but I think it's not going to be dramatic because the demand is so strong for those investment classes that I think cap rates are going to stay relatively stable, at least, you know, in coming months here, and who knows how many years that will go. But it's a fascinating asset class to see how frothy it's become. Only more frothy than multifamily, really, and it's the only asset class during this recent COVID-induced downturn. It's the only asset class that actually has performed better than multifamily. In prior downturns over the last 30 years, multifamily has always been number one, and this most recent one, if you look at the data, industrial has fared a bit better. So,
for sure, and it probably Vanessa beat me to the punch on one of my questions. I might add, what are the hottest real estate investment plays now? Multifamily, we're going to get to a little more of that in a couple of minutes. Industrial, which we just spoke about. You mentioned a little niche, but intriguing on office into life sciences. That could be intriguing. And would you consider healthcare? Would that be different than senior care? But that looks like it could be an interesting opportunity as well.
Yep. I mean, I think the three categories that seem to be, well, they're clearly most frothy right now. It's industrial, multifamily, and healthcare.
Yes.
And yes, healthcare is different than senior care. Senior care as an asset class has a healthcare operational component, other than independent living. But 3 of the 4 senior care asset classes have a healthcare operational component, but it's not the same as a healthcare investment asset class. So healthcare investment asset classes like MOBs, et cetera, it's one of the asset types that has gotten even hotter following the shakeup from the pandemic, right? So this year, healthcare pricing is at record levels. Cap rates are also trending down. So you've been watching that at all. It's fascinating. So if you're thinking about going deeper into healthcare investments, be aware that the one thing I would say is just be aware that this asset class will probably have to navigate some regulatory challenges ahead that could impact momentum, maybe positively, but more often than not, regulatory challenges don't impact things positively. The current topic of concern relates to changes in Medicare or changes in tax policy that might cause a dynamic shift in supply or demand and that lease healthcare properties. So healthcare is definitely a strong play right now. I would say that there's that wild card again because it is healthcare and because the volatility in our markets have been caused by healthcare challenges. There is some risk of volatility, but again, demand is going to be there. It's just really largely driven by regulatory concerns and not knowing what those will be. So that's a little bit of a potential cloud over that, but not to say you should completely steer away from that. It's part of a good diversified portfolio.
For sure. Lonnie will probably take the last 15 or so minutes and focus on residential, as something you may know a little bit of a thing about if you're many decades involved specifically in that part of the community. Why don't we start a little bit? I kind of asked this question, but I'm going to twist it a little bit. How will the population migration impact the economy and real estate, specifically residential, single and multifamily homes? So in my backyard, relatively a suburb of New York has been hit very hard. It has recovered better than I would have expected. And property prices in my backyard are probably up 20 or 30% since COVID, as the so-called rich New Yorkers are fleeing to the suburbs. But some people will argue the Northeast, with its antiquated infrastructure, usually heavy taxation, the winters maybe are getting to us. There definitely is a migration to the South. You see Nashville as booming, and obviously Austin and Miami. So I think this goes back to what I said earlier. It's incredibly localized, but your opinion, please.
Yeah, I mean, one thing is clear that the days of big rent discounts in some markets, the pandemic pricing, those days are over. Right? So I think, median rent rose like 15% from a year ago on average. After, in many markets that fell for much of 2020, rents are now rising much faster than before the pandemic. Right now, since January, rents have risen by 16% nationwide, whereas like from 2017 to 19, you'd see a 3 or 4%, increase during those months. So in September, rents did remain, to your point, Angelo, rents did remain below pre-pandemic levels in some large cities, but just, a handful, like, San Francisco, Oakland, San Jose,
Right.
Minneapolis, DC. I mean, 5 or 6 large cities, they remain below pre-pandemic levels. And it's interesting, as we look at a lot of, we use the RD Matrix a lot. It's a data subscription service that we utilize. And if you look at the RD Matrix reports, like from earlier this spring, the Matrix data reported that it would take 5 years for multifamily occupancy to hit the first quarter 2020 levels in gateway cities like New York and San Francisco and LA, and even some secondary metros. But that was this spring they predicted on that, and I think there's still some truth to that, but I don't think it's going to take maybe quite that long. But then you look at some of these other markets that were never on our radar screen, or most people's radar screen. Like, my wife's family is from Boise, Idaho. Some of you probably never heard of Boise. I grew up in Spokane, Washington. Some of you probably never heard of that. But certainly before the pandemic, I don't think most institutional investors even knew about Boise and Spokane, or at least they didn't pay any attention, right? But look, Boise saw the biggest increase in rent during the pandemic. It was up nearly 40%. Wow. Since March of last year, 40%. But here's what's interesting though, even in a market like Boise, so by the way, institutional investors are now chasing Boise. It's crazy. Who would have thought? They saw that, right? But in September, we didn't see really any increase in rents in September. They actually fell in Boise slightly. Spokane, where I grew up, Spokane, Washington, rents were skyrocketing again throughout this year. And again, in September, for the first time, rents declined by like, a point and a half, something like that. So it's hardly much relief, frankly, if you live in Boise or Spokane, because it's still crazy high prices. But the point is that I think that signals that we're seeing some of the markets start to stabilize, where pricing has been going crazy, and some of those, like you mentioned, the Sun Belt cities, they've seen a lot of higher rates. Also, there's people coming back to urban cores for in-person work and for school, and would-be homeowners that are now staying as renters because they were priced out of buying a home, and the overall lack of housing. All of those things are still driving strong rents and strong occupancies, especially in those Sunbelt cities. So very interesting dynamic happening right now in multifamily.
What is the impact of lifting the federal eviction moratorium?
Yeah, good question. Certainly it's starting to raise evictions, coming out of the expiration of the moratorium. Depending on what data you look at, some are forecasting it'll peak at like 1.5 times what you would typically see pre-pandemic. So like, 500,000 evictions could be filed over September, October timeframe. But that's still like 0.5% of the overall renter pool. So it sounds like a lot, but of the 44 million or so in the renter pool, it's like 270,000 potential evictions, which is very hard for all those people, not to discount that at all. But I think rents and vacancies, we don't expect to see those rise dramatically following the results of the end of the eviction moratorium. I think how many at-risk renters there are that will be evicted is going to be greatly impacted by the pace of distribution of federal relief funds.
True.
I haven't looked here lately, but like I think the end of August, early September was just over 5 billion of the 46 billion of rental relief had been distributed by state and local governments. So the fraction of what's available. So, you know, the question is, you know, so like maybe more apropos is, you know, what are we doing about it, right? There are a lot of ways of dealing with the challenges. You know, for us as, you know, owner operator asset managers, it requires a lot of flexibility, great communication, and a lot of hard work. You know, before the end of the moratorium, you know, in our property management processes and responsibilities, you know, they were already shifting because we're fighting to reduce payment delinquencies. It's a complex battle. You had to know the most, you know, recent laws and stay very much in touch with them. It's all been so very fluid. But you know, everybody's goal is trying to see how we can get our hands on money that will help tenants and be a part of the process for relief for our tenants. And that gets complicated because there's literally hundreds of agencies that are channels for these funds. And there was a lot of thought put into how to get the money out more quickly. And residents were the first point of contact, and sometimes that didn't always get the money to the landlords. But you know, those funds are making their way, have been making their way to tenants' hands and into landlords' hands. And as humans, you know, we're clearly responsible as just good human beings. We're responsible to protect the residents as much as we possibly can. We work really hard to do that. As investors, we're also responsible for protecting the assets and the investment. So you can't do that if you empty out the place. You can't do that with overdue balances. So it's unrealistic to think that with the moratorium lifted, every one of these people is going to be evicted. That's not the goal of any operator that I know of. In most cases, we're making the system work where residents are being paid something and people are not getting removed from their homes, and we're working things out, and we have, you know, relatively low eviction rates. And ideally that would be, you know, copied nationwide, but it's probably not realistic. So far our eviction rates have been relatively low. To keep them down requires a lot of work, communications, creativity, and we'll need to keep doing that even more.
Why is there so much investor capital, I would say, starting to chase single family rentals?
Yeah, starting, I would say it started, good point, starting to, but it started to pre-pandemic, but it's like many things dramatically accelerated post-pandemic. So these build to rent communities in particular are quickly becoming one of the most sought after new asset classes. And a lot of reasons for that. There's so much capital that's been chasing multifamily rental properties. It's, as I alluded to, it's so hard to find multifamily deals that make sense these days. Then you have the surging demand for single family rental. Some investment capital is pivoting to these build to rent investments. So it's interesting, like capital sources like, you know, private equity funds and institutional sources have recognized this increased demand for the rental product across the country, and they're basically pivoting away from other asset classes into this one and doubling down on the residential space, because I think everybody is most confident that residential investments have this historically they've fared the best through every downturn. They're most likely to fare best regardless of what happens going forward. So even though traditional multifamily remains really attractive to those investors, there's a big increase in these purpose-built single-family rental communities. And again, the trend has been bubbling up for years, but accelerated recently. I think it's a convergence of demand drivers. COVID-19, of course, has had a profound impact in terms of just fostering people's ability to work from home and all that. And people want these on-site amenities. It's a home with a yard. They can have pets. They can have private outdoor space. They can, you know, there's empty nesters who are seeking convenience of greater mobility and want this space, but they don't have money for a down payment. There's a lot in that category that want to have their own home, but they don't have money for a down payment. So you have these massive complexes being built of single family homes that are for rent. And it's a interesting new class. We haven't actually invested ourselves, though. We've been looking at it.
As we begin to come to a conclusion over the next 10 or so minutes, and you do have for a little bit after the top of the hour, is that good?
Sure.
What is the big picture theme you see in multifamily? I would say more so moving forward into next year in 2022.
Okay. I would say, last year through the first half of this year, there's been this significant additional strengthening in multifamily. Demand has increased rapidly, even faster than we thought it would. So as I said, rent growth and gains in occupancy levels have been very evident, driven by a lot of different factors. Plus the demand was supported by the federal stimulus payments and the reopening of local economies. And so just a combination of all these factors is really expected to continue to support multifamily over the short term and the long term. So we think that national multifamily occupancy rate will probably continue to rise in 2021. Not as much as the current trajectory might suggest, but continue to rise. That's because completions are expected to start outpacing demand over the next 12 to 24 months, I think. So there's been a lot of projects in the works, new buildings coming online, new units coming online now. So even while the demand is just off the charts, there is a fair amount of new supply that's coming down the pipeline. So I think it's going to keep occupancy still fairly stable. We really anticipate that the national multifamily occupancy rate will still stay in that 94, 95% range by the end of this year, and looking at something similar for next year. I would say rent growth certainly was crazy positive in the first half of this year, even though it was negative in many markets some of last year. Very positive this year. And I think that current momentum is going to continue. The pace will slow down at the rate growth, but I think overall rent growth, it certainly surged in second quarter, like 3% in the second quarter alone. But that elevated pace isn't sustainable, and we're not underwriting to that kind of pace. So part of that pace was just the pent-up demand, but bottom line is there is such a shortage of housing. It's like 5.5, 6 million housing units short of meeting the demand, and the new supply is not at all keeping up with that. And so it just seems that every indicator is pointing to a very strong run for multifamily for some years to come.
Yes, it does appear that way. In our final couple of minutes before we wrap up, I have a couple, and I think the audience has some. We'll go maybe rapid fire. Now, this was partially addressed during the lifting of the federal eviction moratorium, but still, is the bigger risk to multifamily real estate deals kind of the hashtag no pay culture? So, okay, the moratorium has been lifted, but still it could be messy, ugly. It may take months. It still is frustrating for really everyone involved. Is there an underlying feeling? I don't know. I hate to say, but maybe more so with Gen Z or millennials, of a little bit of that feeling and culture. And might they have a point in the terms of the mortgage lenders that organizations like yours have? Was there breaks that you guys got that are still in place, or have they been lifted?
Yeah, great question. First of all, no, we didn't get any real breaks from lenders. In fact, we had to put up huge reserves, COVID reserves, a year or more reserves. That we're now getting a break from having to put up those reserves, which is good. But in terms of the no pay culture, certainly there's a dynamic of that there. But our experience has been it's a very small segment of our overall culture. And we manage the quality of our resident base very, very carefully. And because of that, even during the worst of the no pay times during the pandemic, we still had exceptionally high collection rates compared to the industry. So what we have seen, just big picture, data-driven stuff here, is that in general, non-professionally managed multifamily investments have a higher percentage of those no pay, and of course class C, the lower end of the spectrum on asset classes in multifamily, has a higher incidence of delinquencies. But really, we were still in the high 90s during the worst of the pandemic, and most professionally managed properties in most markets, not all markets, because there's also the market dynamics, unique market dynamics, but the majority of the markets, those properties that are professionally managed really don't see a significant impact from that at all. So I still have great faith in our country, and that we're not going to be overwhelmed with a majority culture of get something for nothing, even in coming generations. But there will always be a segment of that, but that's why you manage well.
If interest rates were to rise, is that a danger to your investors?
Yeah, well, it's not a danger to our current investors or our current investment, because we tend to either have fixed rate interest or put a cap on all of our interest rates if we get a floating. So we're very, very careful on that, and I've learned that over doing this for 30 years.
Yes.
But in terms of looking forward, yes, interest rates, after falling for much of 2020, it's interesting to see that interest rates now, mortgage rates rose to a 3-month high here recently. Right. As the bond markets reacted to the Fed's announcement that it would soon begin tapering its fixed asset purchases, right? But it's clear that rates are probably more inclined to trickle up, to increase as opposed to decrease. But I would say that outlook comes with a caveat. If the COVID pandemic or some version of it worsens with new variants and consumers snapshot their pocketbooks again because they're too afraid to go to stores and restaurants, then all bets are off. Sure. But that aside, most likely interest rates will continue to climb, which will put upward pressure on cap rates, and pricing will go up. The thing I love about rental-based, especially residential rental-based real estate, is that there's a reasonable chance, there may be a lag, but there's a chance that overall market dynamics will increase the ability to drive revenue in proportion with those changing market dynamics also. And so, it still bodes well if you're careful and that you make sure that whatever real estate you're in has a clear strategy for how they'll handle it as interest rates rise.
Will real estate, or I guess even eventually the rent, one day, I'm assuming yes, but when, be tokenized on the blockchain?
Good question. I would say, first of all, we're not experts on that. I'm not an expert on that at all, though I have friends that are, and it's fun talking with them. And so the answer is yes. I think that the blockchain clearly has so many efficiency benefits, cutting out the fat, so to speak, of the system, that this, like many other industries, will be impacted by this over time, and that we'll see over time more real estate being tokenized because of all the advantages that comes from token-backed securities. And the ability to pay. So I think that it's a clear trend. We actually have researched a fair bit, started down the path to say, should we really jump into this now? It's a bit early, I think, to pioneer that, unless your whole gig is pioneering things in the U.S. Though there's some countries who are definitely further down the road than we are.
There's a final question, then we'll go to direct close from the audience. What would it take to burst the suburban housing bubble, specifically your backyard in the Northwest, or is it a bubble?
So I would say it is, bubbles are flexible things, right? So, it depends on what you call a bubble, right? We're certainly at a high, as I said. as interest rates go up, it will soften the dramatic increase of pricing. And so, yeah, it's inevitable that it can't be at this frothy rate forever. But will we see the kind of dramatic drops we saw in 08, 09? I don't think so. I think it's going to be, much more measured. Again, key play here is key mindset as investors. Think long term. Make sure that you're investing in things that have good long-term outcomes, and or have a unique story that you really believe in, a unique strategy to back that story.
Lonnie, this has been great. Really enjoyed having this discussion today and looking forward to seeing you in person at an event sooner rather than later. For those that would like to learn more about what you do, and I'm assuming more so from them being a qualified purchaser perspective, is there a website or something they could go to learn more?
Sure, just go to wilkinsoncorporation.com. It's WILKINSON, corporation spelled out.com.
That is pretty simple and straightforward. Everyone, I'm Angelo Robles, the founder at Family Office Association, the host of the Angelo Robles podcast. You can learn more about my core company, Family Office Association, at familyofficeassociation.com. My direct email is angelo@familyofficeassociation.com. And I do recommend following us on social media, specifically YouTube, where simply Family Office is the channel. You'll find it, subscribe, it's free. A fair number of our videos, not all of them make it up there. For those of you that want more direct access to masterclasses, handbooks, and in-person events, you have to join Family Office Association. So check it out. Again, our live participants, thank you so much. Those that watch and listen in, thank you as well. And of course, a special thank you to our guest, Lonnie Gienger. Lonnie, thank you so much.
Thanks, Angelo.
Pleasure.